Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Well, it's May. It's May. So should you sell in May and go away because cash is king, or is cash trash? And you should buy the dip because the market always comes back, right? And then once you buy the dip, you should never sell because it's only a loss once you sell it. Oh, God, advisors still say that stupid moron. It's so dumb, I can't stand it. That's wrong, folks. That's a lie. It's a lie. It's a flat out lie. Anyway, I got this interesting. I got this one mailbag sent from me from MB on 5.5, and he said, I said an interesting article on the phrase sell in May and go away. And it's kind of just about the history of that phrase. And so I thought, you know what? I'm going to do a show about these dogmas, these dumb quotes. Cash is king, cash is trash, buy the dip. The market always comes back. And the most moronic at all that advisors still do, it's not a loss until you sell it, folks. It's a loss the moment that stock went down. The moment your spouse finds out about it, it's a loss. The moment you have less money, it's a loss. Because actually, the stock always doesn't come back. Some go bankrupt, some stay down for years. So that's another lie promulgated by Wall Street. Okay? But in any event, so the question is, should you sell in May and go away because Wall Street and the Stock Traders Almanac says to do so because that's the averages. That's the on average, about 65% of the time, May through October is the weaker part of the year, and the other 6 months is better. So what does that mean? Let's quantify. Okay. So when you say, look, if you're trying to go for average returns, I mean, at Revere, we're trying to make market-like returns, S&P-like returns with far less risk, far less drawdown, and we've been doing that, or make alpha, make excess returns. Because if you're just trying to do average, you don't need an advisor. You can do that dumb pie charts or us asset allocation model. I'm sorry, you're going to make an average about 7% return roughly, and you're going to have to deal with a 30 or 35% drawdown every 4, 5, 6 years. That's what average is. I'd rather not have average. I'd rather have higher returns by 3, 4, 5% on average, annualized, with a lot less drawdown, a third or a half. But that's me. In any event, it means that you're going to be low. It means that you're going to have to work harder and longer. And is that pie chart to us, that asset allocation where you got rotten fruit with the good fruit, right? To get that average return. Don't you want to focus on the best areas and then move to cash when it's dangerous and then rinse and repeat and do that? That to me is because when it hits the fan, all the stuff goes down together. Diversification does not protect you. That's the problem. That's the lie. So in any event, the media has been harping on all these negatives right now. I'm talking about currently, okay? Currently, the media is harping on all these negatives because the market just experienced this very, very, very brief, very quick day or intraday bear market where it hit 20%. Not Revere, we were single digit in Grotection, right? So it was a very brief, quick bear market just a month ago. And the market, the S&P is almost back even now, okay? So it's been a rally, and some of these tariff deals are starting to get done. If China signs a deal, and who knows, maybe the market's already front run, maybe it'll actually sell off 20%. But I would have to, if I had to guess, if I have to forecast, which we don't do, price is truth, no exceptions, I would say the market could rip, snort, rally 20, 25, 30% from here. If you're not supple enough in your mind to believe that could happen in 30, 60 days, and you have a plan to implement that and ramp up quickly, that's what we're doing. And we also have a plan in case it wets the bed or the China deal doesn't get done and the market starts selling off. We've got a plan to move to cash. Because here's the truth, folks. Here's the real truth. You want the real, how professionals do it? When the market's going down, cash is king. When the market's going up, cash is trash. So the point is, both of those statements are true at different time periods in the market based on price. So what is price telling us? Sell in May and go away is based on some kind of just, quote, some weak average. It's not that it's actually been losing some of its relevance lately. But is that a better way to do it? Or is the market actually setting up to actually rally hard and you may sell in May and go away because you're just told that and you're told to buy the dip? Anyway, with that, let's go to Don and the team and find out what price is telling us and where you should be so you don't have the rotten fruit in the Pie Charts or Us portfolio. Don?
There's really probably never been a greater case of a hated market rallying than what we've got right now. For one thing, you've got half the country despising the administration. You've also got AAII, the American Association of Individual Investors, have been above 50% bears for 6 weeks, which is an incredibly long period of time. They've been way off sides. And a lot of the delving into the data is a lot of it is Trump derangement syndrome. People just can't believe that a person that they despise can do anything in a positive light. But we set politics aside here at Revere, and we focus on what's going on with the charts, with the leading stocks, with the price action of the indexes. And we came off the low about 3 weeks ago. This was the big panic when the reciprocal tariff percentages were announced. A week later, Trump announced that he was rescinding the tariffs on everybody except for China while they did a 90-day negotiation period. The market had a huge bounce then, but didn't progress above that level for another 2 weeks as we bounced around. But as we come off this level, 7 days ago, we had a breakout above this 5,500 level, which we had been highlighting as a key support/resistance area. We got above it. We had a 1-day shakeout, which is you love to see. You always want to see a level tested and it hold. Otherwise, it's a false breakout. And then the old saying that we have from failed moves come fast moves in the opposite direction can kick in. So we broke above that level, and now for 7 days we've been consolidating in the S&P 500 right below the 200-day moving average, just kind of playing ping pong between the top of the range and the bottom of the range, with the rising the purple line here, the rising 8-day exponential moving average providing support in several of those days. We really want to see that level hold on any further pullback. Additionally, we've got the short-term moving average that we use, the green line, the 21-day exponential moving average is going to cross up through the 50-day moving average next week. And the 50-day moving average is finally showing signs of flattening out. Mm-hmm. I showed some examples in the video last night about how if you use some different weighted exponential moving averages that are still considered medium term, but you throw those exponential moving averages, throw additional weight to the more recent days, it's already flattened and turned up and has been providing some support. Particularly, I'm talking about the 63-day exponential moving average, which I know a lot of traders use. The 63 and the 65 are kind of common as a spot to where if you overshoot the 50-day moving average, it tends to provide support. We don't talk about it much here, but it's something we are aware of. So really what we're looking at now is what's the outcome of this 7-day consolidation that we're in. A break above it will most likely mean a surpassing of the 200-day moving average, which obviously is a big level for us. It's a big level for the industry because all bear markets occur below that level. We hit that bear market level twice intraday during this second part, the second leg down that we had where we bottomed in early April. If you look at the NASDAQ 100, which has taken on a leadership role over the last 2 weeks, as evidenced by the rising relative strength line, you can see we're in the same 7-day consolidation, but the upside coincides with the 200-day moving average. Again, big level. We failed there a week ago. We got above it for a few hours yesterday, failed at the end of the day, and touched it again today. So it is acting as a significant resistance level. That's why I asked the question in the video last night: are the indexes stalling at key resistance? And they are for now. But the more times that you knock on a resistance level, just the same thing as the more times that you hit a support level, it weakens. It's like taking a hammer to a board that you're trying to break. Every strike weakens it slightly. Do you give up before it breaks, or do you keep pounding on it until it finally breaks? And that's really what we're looking at, taking complete emotions out of it, looking at what's going on with these two major indexes. But even better than what's going on with these indexes has been the action of leading stocks and also crypto, which Ted's going to talk about a bit. And I highlighted in last night's video about how the TurboTection portfolio that they run, it's smaller than Grotection. It has the ability to purchase some less liquid names, but also is more active in crypto. And they've had a remarkable 3-4 day run here with TurboTection, which is something we're really glad to offer to the clients as an option. So really, all we're looking at now, Dan, is what's going to happen with the NASDAQ 100 and the S&P 500 at the top of this range, which coincides with the 200-day moving average on the NASDAQ. Slightly higher is the 200-day moving average above the ceiling for the S&P. As of right now, we've been bouncing around. Another consolidation day as of Friday at 11:55 a.m. Eastern Time. The S&P is trading. We're also, and this is good, is we're seeing contracting ranges on the S&P 500, as you can see by these 7-day ranges. I mean, compare that to what was going on during the panic sell-off and then the panic buying that happened when all the shorts had to scramble when Trump suspended the tariffs. So that's good. We always want to see decreasing volatility. Volatility decreases when there's more confidence in the market. It increases when particularly when you're below the 200-day moving average, which we still are, but we're coming off of the lows. So that's another feather in the bull's cap. Earnings season has been somewhat mixed, but leaning toward more bullish than bearish. There, as always, there are blowups during earnings, but we're seeing some gaps up that are very strong, and they're holding and they're progressing higher. That is something that you always want to see in a bullish environment, and we've been detailing those every night on video. So right now there are more checks in the bull column than there are the bear column. From short-term expectations, the green line, the 21-day moving average, we put a lot of weight in that. And as long as our leading stocks and the indexes are above that level, we're going to continue with our exposure to the market with the, and then if we see a sustained move above the 200-day moving average, we see the 50-day and the 21-day come up through the 200-day moving average. When we get all the moving averages aligned in a bullish configuration from shortest term to longest term, that means the 8 above the 21 above the 50 above the 200. That's when we really put the pedal down. We've been throttling our beta below the 1.0 level, which is pretty typical for what we do, while we're below the 200-day moving average. And really the reason it's that high is because of how well leading stocks are acting. We're between 15 to 30% long in the S&P 500, and we can get much longer there as well. But good action from the leading stocks. Right now, a 7-day consolidation in the indexes, and we're looking for what the next cards are going to be dealt by the market, by the administration. But more importantly than the cards is how the market reacts to them. I mean, it's very possible that we start signing tariff deals and it's a sell the news event. If Jerome Powell didn't help the markets at all this week when he came out saying how he's conflicted by his dual mandate, which is low unemployment and price stability, because he's seeing signs of inflation while the job market weakens. So you can't lower rates because that'll increase inflation, although that would help with unemployment. But the market has, kind of shook it off. There was a UK tariff deal, a small one, announced on Thursday. And so far, everything that the market has had thrown at it since the shakeout day a week and a half ago has been to the benefit of bulls.
Hey, Don. So the AAII, that's the retail investor, right? Investor group. Do
Right.
you? And that's negative. It's over 50% bearish, and I kind of view that as kind of a contra indicator. How do you look? I mean, that makes me.
It is.
Yeah.
Yeah, it is, and it has been, Dan, and it has been pretty reliable. But it seems like it kind of broke when Trump got reelected because usually they lag. But I'm going to try to find
Well,
it
it's hard
and
with Trump because all
bring it up
his
here.
comments, you get those
Yeah,
the Trump
yeah.
tampered market temper tantrums, and they just go back and forth. So it's a little bit
Yeah,
the
we-
volatility increases. Let me put it that way.
We totally treat it as a contrarian indicator,
Yeah. Secondary.
but they were bullish long before. Let me bring this down here. They got bearish long before the market got bearish, which is hold on a second. What are they doing here?
That's kind of unusual
Yeah,
that they got bearish when the
See,
market got bearish. Normally they
yeah.
lag.
They did, and then didn't rebound when the market started going back up, and that's even more rare because usually it's sentiment that dictates the exposure. But you can
Right.
see the 1-year bearish high was the week ending the end of April. We've gone nowhere but higher since end of April, and we're still over 50% bears, which is odd. But we kind of are leaning toward preferring this NAAIM survey, as I
Mhm.
talked about in the video last night. This is if you stack where the NAAIM, and now this is professional money managers. So
Right.
if the market's going up and they're not putting, they're going to get fired. So plain and simple, this one is, we consider it more reliable. You can see whenever they approach this 100 level, which means fully invested, it usually means a short-term top in the market. It happened here, it happened here, it happened here, it happened here. But similarly, when it goes below 60, it's a buying opportunity, which we just saw 2 weeks ago. And you can see the market bottom there. It got below 60, the market bottom there. Pretty reliable. Market bottom tier 2 when it got at 60. So right now this is up.
The indicator is pretty reliable, but actually that also demonstrates that even the professional money managers, a lot of them aren't that good. If they're lagging, you know what I mean?
Well,
Yeah.
very true. But
Yeah.
what it says is, okay, we sold everything we're going to sell.
Right.
And then it's like, okay, we're getting back in. All right, we bought everything that we're going to buy. And
Yeah.
that's what puts in the short-term tops and bottoms.
Right.
Right now it's at an 81. We don't get concerned unless it gets above 95.
Right.
Which if the market keeps going higher, it will. And then we'll see a short-term pullback, consolidation. They'll pull back. If it gets below 60, it seems like a decent indicator to keep an eye out for buying opportunities into pullbacks or
Right.
A reemergence of breakouts starting to work again.
Yeah.
So,
And with that AAII, with them 50% bearish folks, what that means is a lot of those retail investors are holding quite, if half the people are bearish, they're holding a lot of cash. And if the market continues to go up from here, goes up a little bit, they'll start getting FOMO and they'll start getting worried that they're missing out and they'll start putting the cash to work. That's why cash on the sidelines when the market starts to rally is actually bullish.
yeah, except that they really haven't since the bottom on 4.2. They bottomed at 61% right here.
Right.
So they were early, but we've, rallied 15% off
Yeah,
the lows, and
they haven't gotten
they're
in yet.
still,
Yeah.
they haven't gotten in yet.
Yeah.
So I think it really is a political bias showing, but that's okay. We'll, they're secondary indicators. Some are stronger than others. We use a lot of them. We show them on the tail of the tape every night. We talk about them on the videos and how they're impacting our thinking or our leaning, and it's just a matter of weighing the evidence.
Yep.
And price and volume are obviously overweigh those secondary indicators.
Right.
So that's where we are on the S&P 500. Any more questions before we move on to the fellas?
Nope. Let's go to who's first.
Let's go with Todd. He's going to talk about two things. He's going to follow up on your sell in May, Dan, showing we talked about the Zweig breadth thrust that we had days ago last week, and he's going to talk about that, and he's going to show some of those gap up stocks that we talked about that are acting pretty well. So let me get this sized up correctly, Todd, and then you can take it away.
Thank you, Don. As Dan was talking about, yeah. All right, so as Dan was talking about the sell in May, I came across this particular slide this past week and found it interesting. So I thought I'd interject it into our podcast here. And it just so happens that when you have a Zweig breadth thrust, and that's what we talked about last week, and it occurs within 6 months of May 1st, you can see it's occurred on 1, 2, 3, 4, 5, 7 times. Now we're on number 8. And historically, we've averaged 6.8% returns during the May to October period versus 1.3% in normal years. So just a quick little tidbit that it's had a near perfect record, or a perfect record of outsized returns during these periods. So another one of these data points to hopefully look forward to during this period that's typically a little more challenging. So now I want to talk about 3 stocks that had decent earnings reaction so far. And I just want to say that so far, I find this earnings season to be pretty strong, and I would rate it a solid B+. And what I like about this particular earnings season compared to last earnings season is it's been much more orderly in the way it's behaved. If you recall last earnings season, we had a lot of massive gap ups. Everything was gapping up left and right, and everything eventually failed as the market topped. However, this one's been a little more muted and a little bit more sanguine, which is good, and it's giving a lot of people a chance to get into some of these plays. The first one I want to talk about is TOST, which is an example that happened today. They reported earnings, and I'm not going to get into the numbers. I'm just going to talk about the reaction and the chart patterns. But TOST had a nice beat and raise. They beat by over 20%, and the stock is gapping open today about 12%. So this would qualify as a power earnings gap at this point. It had big volume yesterday, and it broke out today of this low-level cup with handle base. And I'm watching this because it also just so happens that 40 was the IPO price of this stock back when they IPO'd too. So you had this previous base. Again, it traded higher than the IPO price. It opened up higher, but the actual IPO offering was at $40. And you had this previous base that it formed last quarter that this current cup with low handle broke below. So it reset the base count, and now you have a new stage 1 base here. So this is an innovator in the restaurant technology area where they offer both hardware and software to run the front end of the office as well as the back end of the restaurant. So this is one I'm watching. The next one is Duolingo.
Todd, before we go on to the next one, you brought up a fantastic point that I want to point out. You said what you're seeing this earnings season compared to last earnings season, and TOST is a perfect example of this. Look at the gap up that it had on its earnings report last time, but what was the market doing? These things just simply can't work when you're in a bearish phase. Compare that to 2 earnings releases ago where the market was in an uptrend. It gapped up on earnings and it kept going and went on an extremely strong run from 35 to 44 in 2 weeks. So we're not saying that it's a guarantee that that's going to happen this time, but this is a perfect example of how you can compare earnings gaps under 2 different environments in the market and see the different results. So good stuff there, pointing out that, yeah, we did undercut with the base, and now we've got a fresh stage 1 base in a stock that's got strong fundamentals. So good stuff there. All right, your next one is Duolingo.
Yes, Duolingo is, I just wanted to bring this up because this is a pretty strong monster earnings gap. And a couple things to note here. This is an innovator in the language area where they're using artificial intelligence to teach languages primarily, and they've gamified the process of learning a language, and they've made it fun. And one of the ways they're using AI, it took them over 12 years to develop their first 100 courses. And within the last year, they've developed an additional 150 courses using AI. So they are definitely leveraging this. And they also had a great quarter. And what makes this a monster earnings gap is it gapped up over 20%, and it traded volume of 191%, which is just shy of the 200% requirement. But in the spirit of monster gaps, I'm going to call this one a monster gap. And you can see that this one gapped higher, and it's made progress every single day above the high volume close area. So, difficult to get in, but it did gap into this cut base pivot, and it's made progress every single day. So it's definitely a stock to keep on your radar screen. And the final stock I want to talk about is Robinhood. And here's an example of one that was a little more methodical in developing. It wasn't a gap necessarily. They reported earnings, and it had actually somewhat of a reversal on the earnings day. But the notable thing with Robinhood that I found interesting, and that the team found interesting, is after the earnings report, it had 2 tests of the 21-day moving average on both the 5th and 6th. And it closed at the highs of the day on both of those tests. So this one, it was a great report. It was a beat and raise across the board. It's providing the new factor in CanSlim with FinTech. They have several new offerings, and it's a stock that's been on our fundamental watch list for a long time. And we accumulated positions in this as it tested the 21 EMA and held post earnings. So this is a very strong, and now we're getting positive feedback. All the moving averages are now turning positive, including the 50-day moving average, which is now trending up. So we're getting positive feedback. Again, a nice quiet earnings reaction, but a follow through with the market. So these are just 3 examples of reports that we're either in or watching.
Excellent stuff, Todd. And like you said, there's been quite a few more of these. And Connor's going to talk about a couple of them too as we transition over to Connor. Take it away.
Yes, that was really good, Todd. Short segment today. I want to talk about 2 setups and then some other strong earnings gaps that we've seen this week. And just to piggyback off Todd, is that one of the best earnings seasons that we all think that we've seen in a while. So that's a positive sign. But some non-earning setups that we are watching here. Tesla, this one, pretty simple setup. Nice base here. Just reclaimed the 200-day moving average. It's got pretty nice volume today, and it had that really tight consolidation. And the characteristics of Tesla stock is that once it gets going, it tends to be a freight train. So a lot of catalysts on the horizon for this one. And this can continue and stay above the 200-day moving average. What Don's pointing out right there made an unbelievable run at the end of 2024. And throughout the history of this stock, it's made so many great runs. So, there's a reason why everyone has a soft spot in their heart for Tesla. But good action on this one today. It was, over 300, and now it's came back with the market. But as long as it doesn't break, yesterday's lows, it still looks pretty constructive. So that is one that we're watching here at Revere. And then another one is OTKA, and this reported earlier this year, but not a whole lot to say about this one other than it's in a super strong group. Relative strength line is at new highs. You got CrowdStrike, CS, other cybersecurities acting really well, and this one's at the top of the range. So maybe a little bit short-term extended here after multiple days up in a row, but if this one could handle out and, or put some tight days in, let that 50-day slope up a little bit more, it would look fantastic. And if you go to the weekly, Don, this is, we love the stage 1 bases, and this has just got an awesome stage 1 base, and stage 2 advances where you can make the majority of your money, and that stage 2 is just starting now. So this one's on high radar for potential entry, looking for some tight days, a potential pullback, potential handle. And as long as the cybersecurity group stays strong, this one's at the front of our screens. So that's 2 setups, and then just some earnings that it's been a really strong week. So if you pull up Dave, now these ones, Dave's trading about 80 million daily dollar volume, and this one gapped out of a huge base. And to me, this fits all the criteria for a positive earnings gap. This broke out of a range, had huge volume, putting into day 2 higher high, good earnings beat. And it's exactly the type of action that you want to see. And when you see stocks acting like this on earnings, to me, that's just a big tell about being in a positive environment. Like Don and Todd mentioned, in a weak market, you might get a gap up and then you usually close low a day, but day 2 higher highs are extremely bullish. So, and these tend to set up many other times along the way. We've talked about how dynamic earnings gaps are. You can buy them on day 1. You can take them through high volume close on day 2. You can wait for, an 8 EMA tap once that catches up. So there really is many ways to play it. And these tend to continue. There's a phenomenon on Wall Street, which is post earnings drift. And when you see that gap up, a lot of times the Wall Street's caught off guard and they start to accumulate these stocks for weeks. So good action from Dave. Sezzle is another one. This one, again, gapping out of a nice base here above that left side peak. That's another thing I love to see. Sometimes names gapping up into a left side resistance that can act as overhead, but this one's putting in a day 2 higher high again today, and it had all the characteristics. Pretty strong earnings beat, huge volume, day 2 higher high, gapping out of a range in a pretty solid sector. So again, similar thing what I was mentioning on the last chart. Just keep an eye on these ones for continuation, pullbacks, follow through, and as long as these hold, I think it's just a really good sign for the market. And then last one, HIMS, which we all engaged with. I touched on this one in the week or on my Tuesday video, and this one just continues to act awesome. It had that shelf offering that Don mentioned in the video yesterday, and buyers stepped up, and you can't really ask for much more in 3-4 days later from an earnings gap. So this one's starting to flag out pretty nicely, and as long as the market stays healthy, this could continue higher, and it looks like it's forming a flag, letting those moving averages catch up. And then the volume signature on this one was extremely good. Huge volume, closed at the highs of the day, and followed through the following days. So, and I touched on this in the Tuesday nightly video as well. Another characteristic is they never break low a day. Right when the market opens, tends to be a stampede of volume buying, and they just kind of continue higher. And yeah, he's showing it right now, and you can see right off the open, really strong push, normal to pull back, and then close near the highs. And you can see on the days following, it's just been drifting higher, hasn't even challenged that low on the earnings day. So just phenomenal action across the board, really, in earnings, and that's really good to see. You know, we always pay close attention during earnings seasons as we like to buy the gaps. But again, it's also just a really good general, you know, like a health check for the market. If we start to see earnings gaps get faded, that could signal a bearish tone. But for now, it's been super positive.
Great summary, Connor. Appreciate that. And let's take it over to Ted now. Ted's going to take control of the screens. He's got some crypto news and insight to offer. Take it away, Ted.
Thank you, Don. So first I wanted to discuss Ethereum. When Don first mentioned it on the video, it's definitely a less traditional trade that we do at Revere. But this is a good teaching moment as well. You know, we've talked about, Connor's presented on it, I presented on it, stage analysis. And we usually talk about the 4 stages: stage 1, the basing phase; stage 2, the uptrend; stage 3, topping phase; and then stage 4, the downtrend. What we did leave out was one nuance. And from his stage analysis, Stan's stage analysis, towards the end of stage 4, there's a stage called stage 4B minus. And this was essentially the trade on Ethereum. What stage 4B minus is, you have this prolonged downtrend, and then it gets extended from the longer term moving averages. And what that creates is an air pocket. And that's at least the term I call it, an air pocket to the longer term moving averages. And how you identify that is, you have a long period of downtrending action. Eventually, you put in a low, then you see some higher lows. You see and on here I have the 10, 20, and 50, but it's pretty much the same as the 8, 21, and 50. Eventually, you see price get extremely tight, and those moving averages converge, and that's what happened on Ethereum. And I identified Ethereum as a potential opportunity on this day right here. You can see how tight the 10, which is the purple, 20, the green, and the 50 aligned. And this pivot here was only, let's show it, about 7% wide. And for a volatile name like Ethereum in crypto, that's extremely tight. So in Turbo, we took a 5% position on May 1st, and this is really how it played out. It took a bit of patience, though, as you can see. For over the next week, it kind of just did nothing, tried to shake us out, but we were able to stay in since we had our stops around this 1700 area at the lows of the pivot. And yesterday, we had some good news with trade deals, and overnight, just a really nice 22% move yesterday. And that's when we trimmed 50% off, as Don highlighted in the daily video. So pretty much this was a non-traditional trade. We were just looking for the mean reversion, which is exactly what we got today. We saw the retake of this 2100 undercut and reclaim level. I don't have a 100-day moving average on this chart right now, but it's around this area, this 2100 area, which we blew through, and that quickly pushed us to this declining 150. So another action, which I will show in tonight's Friday video, we also took off another 50%. So we're left with 25% of the remaining position. And this trade is pretty much done here. The expectation was never that this was just going to blast off into highs and have a smooth trender like some of the stocks Todd and Connor shared with full moving average alignment. But on the flip side, this was a mean reversion trade. Now I want to talk about
hang on, Ted, hang on. Do you still have 50% left, or did you sell it all?
We have 25% of the original left.
Okay, so what's the plan to trail that up? I'm just for the listener, so you can kind of give them insight.
Oh, for the trail right now, we just have a break-even stop, so we're not going to let the rest of the position come into our average, and eventually we're going to start trailing probably the 10-day or the 8 EMA up, and see maybe if we can consolidate up here around the 150, 200, and perhaps this does turn into uptrend. But my expectation is there will be a lot of frustration in this zone right here.
Right.
And
so you're going to trail up the stop and let it play out. Got it.
Yep, exactly. The zone up here in this like 2,500 to 3,000 area, there's resistance. There's the 150-day and 200-day. So we're going to trail it. If it continues to work, we'll hold it. but the premise of the trade was just the mean reversion into the longer term moving averages.
Yeah.
So on the flip side, with a potentially trending stock or security, the first one I want to talk about, and we're returning back to it, and it's one of my favorite names, is Bitcoin. We had this huge move post-election, and then we pretty much gave it all back. But as the markets crashed, Bitcoin even held the top of the previous base, retested it, and held a rising 40-week and 30-week moving average. So immediately that to me screamed relative strength. And I started stalking this name or this cryptocurrency once again. You had the undercut reclaim of the 76,500 level, and then similar to ETH, it formed an extremely tight pivot here, only 4% wide for this name. And once again, the 10, 20, 50 converged, and I believe we took our initial 2.5% starter somewhere in this pivot. I believe it was April 15th, and that just meandered around a little bit, but eventually got going. And so far, it's climbing up the right side of the base, pretty much exactly as I've wanted it to. It's acting perfectly so far. And right now we're running into this 107,000 to 108,000 previous all-time high. And what I now want to see is more right side development in this base. As you can see, there's a lot of action on the left side in this middle area, but so far the right side has been vertical. And with that, along with the 10-week being far below the 20-week, that usually adds as like a magnet for price. So I wouldn't be surprised if Bitcoin pulled in, maybe even retested this 94, 95,000 area, built a handle, and then tried breaking out into all-time highs. So that is what I'm looking for there in Bitcoin. Similarly, MSTR is a name in equities that you can play, or you can use IBIT, the Bitcoin ETF as well. This also held a rising 200-day moving average and 40-week as the markets crashed, and it didn't even retest the previous base breakout high. So once again, relative strength right there. This actually even made a higher low relative to those March lows. So that was another sign of relative strength. Then it just really has ripped up the right side of the base. It's taking out this 400 level so far, reversing right now against this like 430 area. Same with Bitcoin. I would love to see a right side develop now. You can see how vertical this has been. And now it's about 24% extended from the 10-week moving average. And so I do expect some back and fill action, maybe even back to like this 360, 380 area, or it can just be even tighter above 400, which is ideal, and have the moving averages catch up to price. And then perhaps we can go for all-time highs as well. But what I do like here is the 10, 20, and 30 right here have converged literally within 1% of each other. And when MSTR is over like 6-7% ATR, maybe even more now, that is extremely tight from the moving averages. And when you have tight moving averages, that often can lead to expansion. Like right here, you can see the 10, 20, and 30-week moving averages were extremely tight. Then it led to expansion, and this led to a nearly 200% move in MSTR. So that is what I'm looking for there. And then finally, I talked about this name in depth on a previous podcast that you can look for. Uber, it had earnings recently, and it didn't gap out of the base, but still acted pretty well. It sold off initially, but clearly institutions came in and supported it. And right now it's building a really, really constructive handle here. Super tight, respecting these price levels really well. This 82.2 area held, and now really the last level is 87. It's all-time highs. And we own this in both Protection and Turbo as a disclaimer, and we'll probably look to add onto it into all-time highs. And I'm not going to dive deep into the fundamentals since I already have on a previous podcast, and we could definitely link you to that. If any of you have any questions, you can just email us. So that is it. Ethereum, a mean reversion trade, less non-typical to how we do things at Revere, and then 3 typical bases that are typical to what we do here at Revere in our trend following strategy.
Great stuff, Ted. That is everything from the tech side. Dan, you can take it away.
Folks, does your advisor sound like these guys? Or is your advisor, are they asking you for a tea time or just to go to lunch? Our team doesn't go to lunch when the market's open, folks. They're watching your portfolios. They're managing your money. Look, if you're tired of getting these contradictory dogmas, cash is king, cash is trash, sell in May and go away, and just these dogmas, depending on what the market is doing and which throwaway line they're going to pick out and provide to you that fits that particular thing, or is it a better way, instead of that pie charts or us, where they take your money and spread it out amongst all their real clients, the muni bond, the corporate, the tech stock, the treasury bonds? Instead of doing that, why don't you learn a professional way to invest money, where you look at every investment in our portfolios has to earn its way onto our portfolio. We don't pre-select and we don't do products. Okay, they've got to earn their way onto our portfolio, and they got to continue to earn their way onto our portfolio. Because at Revere, price is truth, no exceptions. If you're arguing with price, you're arguing with truth. Listen, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button, and you can just put your name and email address in there, and this podcast will go right to your inbox Saturday morning. And the daily market insight videos, the videos the guys do every day the market's open, will go into your inbox at night once they publish it. Now, if you go to YouTube and just sign up, just search for Revere Asset, just Revere Asset, hit subscribe. Zach, our producer, to have this thing out by 1 o'clock Central Time. That's how the stock nerds do it. They get it in closer to real time. So there's two ways to get our content: our website or our YouTube channel. And you can always call if you want a complimentary portfolio review or just want a topic discussed. There's a contact us button next to us. And you can always call us old school at 855-REAL-WEALTH. Folks, we'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not how much you make in the market, it's how much you can keep.